So now that we have completed the discussion on the financial statements, now we have to talk about the next step in our accounting cycle, which is called closing entries. So let me mention that here, closing entries. So I hope so far you've been following along. So it's everything is like dependent on the previous thing, right? So we do this, like everything has to be sequential to get the accounting done. Now let me give you a brief introduction to like what are closing entries and why do we need to have the closing entries. So I'm going to start with a new sheet here. Okay. So far we have talked about 5 different category of accounts. We have talked about assets, liabilities, equity, revenues, and expenses. So now that you understand like which accounts are asset, which accounts are liabilities, at least like have a good foundational idea, let's discuss another thing. So let's assume for a moment that you have a friend who has a business, right? Now if you ask your friend, like let's assume you ask your friend, what do you own? Your friend will tell you, okay, I own a laptop, I own a house, I own a car, like, so that means when we are talking about assets, it doesn't really matter what time we're talking about, right? What I have is what I have, it doesn't relate to the time period. Okay. Same with the liabilities. If you ask your friend, what do you owe? Your friend will tell you, I have the bank loan that I owe to the bank. I have borrowed some money from this friend of mine. I owe him money. And like any of the liabilities work the same way. So when you have assets, liabilities, and similarly equity, because equity is just assets minus liabilities. So these 3 things are not dependent on time, means they don't end once the time period ends. Like for example, what I own this year will be exactly what I will have the next year, unless of course I sell it, but otherwise I will still have that. So these 3 are called permanent accounts. That's why, because they keep let's say going even if the accounting period ends. So these are called permanent accounts. Means again, these accounts will not be like restarted in the next accounting period to start counting from 0 again. No, whatever I have this year, I'll continue counting from that number to whatever I do in the next accounting period. However, if you ask your friend, like, what was your revenue this year? Also, just let me just ask this way. If you ask your friend, what was your revenue? Now, here your friend will ask you, like, what do you mean? Do you mean how much revenue I made this year, this month, last 6 months? Like, for what time period do you want the revenue for? So we inherently know that revenues are related to a time period. Like, no one that you go to ask, like, what's your revenue? They will not really tell you the total revenue they generated from the start of the company 20 years back until now. No. When you're talking about revenue, it has to be related to a time period. Okay, this was my revenue in January, this was my revenue in February, or it can be yearly time period. This was my revenue in 2020, this was my revenue in 2021. So revenues inherently belong to a time period. We know that. Again, like if you ask your friend will never give you the like, or let's say your friend wouldn't give you the direct answer probably, because your friend will like wonder what time period revenue do you want to know about the business. Okay. Similarly, the expenses work the same way. So when you ask your friend, how much did you pay in rent? Okay. Now, again, we have to talk about time period. Okay. Do you mean like this month, last month, month before that? So just like that, every expense is also related to a time period. When you are talking about what was the expense, you can never just say the total expense. Like if you ask your friend what was how much rent did you pay, your friend will not really tell you the rent he has been paying from the start, like 5 years ago until now. No one does that, right? Your friend will not tell you the rent for a certain time period that you want to know about. So that's kind of where the revenues and expenses lie, and this is why these are called temporary accounts. Let's give it a separate color so it's easy to see. There we go. So these are called temporary accounts, means we need to close these accounts at the end of the accounting period. So next accounting period or next year, we can start counting from 0 again to whatever number happens in the next year. So just to say that again, before saying that, let me also write this here for you. These are the accounts that need to be closed at the end of the accounting period. Again, we have been talking about that's usually a year, end of the accounting period, so that next accounting period, the counting of these accounts, the counting of balance in these accounts can start from 0. So I don't want these accounts to already have some money or numbers left over from what I made this year. I want to empty those accounts, so next year I can count the revenues and expenses for that accounting period separately. So there you go. So this is the logic behind temporary accounts and permanent accounts. Permanent accounts are accounts we cannot close because what I have this year is exactly what I'm going to have the next year. So it's not related to time period. What I owe this year, it's not like the year ends and now I don't owe the money anymore. No, you don't owe the money anymore once you pay it back. It doesn't relate to the time period. So I hope that part is clear. And now we are going to talk about the closing entries topic, how we do that. So let's go to this adjusted trial balance that I've copied. Now the reason I have copied this trial balance because it includes a lot of accounts, and if I'm going to explain what closing entries are, I don't want to give you the easiest representation and then you find a complete question and you're confused. So here, yes, you'll see some accounts that you're not familiar with, but that doesn't really matter as long as we know what each account is. Like, is it an asset, liability, equity, and so on. So we are going to do now closing entries. Again, the purpose is to close all of the temporary accounts, so next year we can start counting from 0. We said there are 2 categories that are called temporary accounts, revenues and expenses. So let's close those accounts. And what do I mean by close those accounts? Again, closing accounts mean converting those accounts into 0. So let's see. First, we are going to try to close the revenue accounts. So let's see which revenue accounts do we have. Again, any account you see that you don't know about, ignore that. Don't worry about that, because obviously at this level that's not part of our discussion. Now people will make a mistake. People will think unearned service revenue is a revenue account, but if you remember from our previous classes in the adjusting entries topic, we said unearned revenue is a liability. You have to be very careful. So this is not actually revenue. There we go, service revenue. So now let's think about it. Service revenue has how much money in that account? $106,000 is the balance in the service revenue account. Now, if I want to make it 0, that of course means I need to decrease it by $106,000, so there's nothing left. And revenue, we already know the rules. They increase on credit, decrease on debit. So if I want to decrease it, I'll do service revenue debit by $106,000. Again, let's assume it's the yearly accounting period. So this will make at the end of the year at 31st of December. And any other revenue we have that we also need to remove? No. That seems to be the only revenue. And please remember, other side of the closing entry is always this account called income summary. So if I already have the debit, the credit will be income summary. Now you might say, what is income summary? To give you a way of thinking about this that's very easy, just think of income summary as the income statement. So what we did is we transferred the revenue amount to the income statement so we can calculate profit there, right? So we transferred the revenue here. Again, you don't need to worry about this reasoning. I always try to give extra, let's say, logical understanding. But again, if that does make sense, good for you. If that doesn't, that's not going to bother you ever in your accounting learning. So just remember, whatever one side of the entries, other side will be the income summary. in closing entries. So next one, now we need to close the expense accounts. So let's see if we can spot some expenses. There we go. Salaries and wages expense. Okay. Now again we'll do the same reasoning, right? So since I want to decrease the expense accounts, means I want to convert them into 0, I will have to credit the expenses because they decrease on the credit side. So I'll do here salaries and wages expense credit, which is 46,000, and then we have supplies expense credit. Again, I'm crediting just to remove the amounts, so it becomes 0. Rent expense, we have 9,000. Then we have insurance expense amounting to 500. Then we have interest expense, which is 500 as well. Depreciation expense, which is 400. And last one, bad debt expense, which is 1600. So now that I've already removed all of the money from the expense account, what will be the debit side of the entry? Again, always the other side of the entry is income summary, and this time it will be the sum of all of the numbers, because again we know debits have to be equal to the credits. There you go. Let me also make there we go. So that's the range. So that's how we close the revenue accounts and expense accounts. Now there's a little bit more I need to show you here. So now let's think about it. Okay, so now I transferred all of the revenues into the income statement, means I transferred the balance in the accounts into the income statement. And obviously in the income statement we calculated the profit. And so now what we have to do is we have to close the income summary account itself, because first I increased the income summary account and then I decreased the income summary account. So to close the income summary account, we will obviously do it with the amount of the profit that was generated. So let's see, 31st of December, we will say, let's think about this logically. Okay, income summary increases on credit, decreases on debit. So how much money is in the income summary account? Let's see. I increased by this much, then I decreased by this much. That means the profit was 33,000. And again, we always close it with the profit number. I just want to show you the calculation you can quickly do from here. So 33,000 will be the amount. Okay, we understand that. But what will be debit, what will be credit? Let's think about it. Income summary, I need to close. So I need to debit income summary, since it has a credit balance. It has 106,000 minus 73,000 in the credit side. And what account will this transfer go to? Do you remember we said profit is always transferred to the retained earnings account? So we will increase the equity account called retained earnings by $33,000. So that's the third closing entry. Now we just have one more. Again, you might not have learned the last one that I'm about to show you, but if you have, this will be a good addition to our learning. This is just the last closing entries. You don't have to make anything else. You will not learn any other one. These are the only ones. Okay. Now, when you're making the fourth closing entry, you have to remember this fact that dividends account is a temporary account, even though it doesn't fall into our usual categories. It's not revenue, it's not expense, it's not asset, it's not liability, it's not equity. But just remember, at least for this part of your accounting journey, dividends is a temporary account. Means every year what dividends I pay, I have to count separately. So to close dividend account, if you notice, it already has a debit balance. So I need to credit it to remove that balance. So dividends will be credit. And if you remember the point, we said whenever you pay dividends, the money is taken out from the retained earnings account. So we'll decrease the retained earning account by only 5,000, because that's the amount of profit in the retained earning account that we are paying back to the owners. And that's it for the closing entries. Like I do understand that this is like a lot of things to think about, but that's the great thing about having a course, right? You can also like start the video and stop the video and watch it over and over again, solve the question with me, and see if you can master it. If you cannot, I will just recommend like you can reach out to me obviously here on or let's say whatever platform this course might be on. So yeah, so that's it for this video, and next video will continue in the last step of the accounting cycle called the post-closing trial balance.